Okay, good morning. I'm getting some feedback that the volume was a little bit low, so please confirm if you can hear me clearly now. Thank you all for joining the Nigerian Stock Exchange's Retail Investors Workshop. My name is Ore, and you have my word that today is going to be a very insightful session. So today we have partnered with ARM to discuss the theme value investing versus growth investing. And I'm confident that by the end of this webinar, whatever side you're on, you will be well equipped to make the most of your investment decisions. So by way of housekeeping, there's a number of things I would like you to know today. First, this event runs from 11 a.m. to 12:30 p.m., and we will do our very best to stick within the allotted time. We would appreciate if at any point when you're not speaking, your microphone is muted so that everyone can, hear and participate actively. Also, we want this session to be as interactive as possible. So please, if you have any questions, please use the Q&A function on this Zoom platform to ask your questions during the course of this presentation. Please do not use the chat box to ask questions because it will be a bit difficult for us to track on the chat box. So please use the Q&A box to ask your questions. I would now like to go through the agenda. So I'd like to ask my colleague Friday to please project the agenda so we can all go through that. Thank you. Okay, so to kick us off in today's session, we'll have the divisional head trading business at the NSE, Mr. Jude Chiemeka, to give his welcome address. After which I will return for a short icebreaker and poll session where we would like to interact with you briefly. From 11:15, we will have the first presentation for the day from Mr. Mustafa Alao, Investment Research Analyst at ARM, who will speak on value investing. After that, we will have the second presentation for the day from Sheyi Adeosun, Equities Portfolio Manager, also at ARM, who will give his presentation on growth investing. After that, we will go through the versus session of today's event, which will be moderated by the head ex-academy at the NSC, Ugochi Obi. And then we'll also take your questions at that point in time. So again, please remember to use the Q&A function to ask your questions. After that, I will return for the second poll to ensure that the objectives of today's learning have truly been achieved. Then I'm sure at that point, everyone will have the question on their tongue, how exactly can I make the most of the lessons I've learned today? At that point, we'll have Mr. Benga Magbabeola, the Managing Director, ARM Securities Limited, to give us a presentation on how we can take advantage of the investment opportunities available to us. Then as we inch towards the end of the program, we'll have the vote of thanks from Chidima Chukwueke Okolo, the Head of Retail Investor Coverage at the NSC. After which we will then bring this insightful session to a close. So to kick us off this morning, we have the Divisional Head Trading Business at the NSC, Mr. Jude Chiemeka. Over to you, sir.
All right, thank you, Ore. Distinguished ladies and gentlemen, good morning. And it's indeed my pleasure to welcome you to this Retail Investors webinar, captioned Value Investing versus Growth Investing. The role and significance of the Nigerian stock market in providing and ensuring a well-regulated market for fair and orderly trading of equities and other investment securities cannot be overemphasized. Despite the year 2020 presenting a number of local and global economic challenges, which included layoffs, a great dearth of viable investment opportunities, the Nigerian stock market witnessed what was arguably one of its best years in recent history. The market recorded a number of significant milestones and achievements during the course of the year. One of those milestones was recorded in November 2020, when the NSE's all-share index posted its largest daily gain in more than 5 years, and in so doing triggered the market's circuit breaker. And this was done. This was for the first time since its introduction in 2016. Data also shows that investors recorded over $18 billion in gains from the stock market. And to round off a memorable year. The NSE All-Share Index emerged the best performing index in the world out of 93 global indices tracked by Bloomberg, surpassing global indices such as Dow Jones Industrial Index and the S&P 500 by posting one-year return of over 50%. It is therefore no wonder that the stock market has continued to attract numerous investors. The Nigerian Stock Exchange makes it a high priority to not only provide all investors with an accessible, transparent market where they can achieve their investment objectives, but also to equip investors with the necessary skill and knowledge required to enable them achieve those objectives. But also to equip investors with the knowledge required to meet those objectives. From an investor's perspective, it is important to employ an investment strategy, one that matches your financial goals and objectives, as this is key to building your investment portfolio. This webinar will highlight some of those investment strategies which will help you as investors make the best of the opportunities available in the stock market. I would like to thank ARM Securities Limited for collaborating with us on this Retail Investors webinar. And I would also like to thank you, the attendees, for taking out time out of your very busy schedules to join us today at this event. I urge you, therefore, to pay close attention to the presentations and all the discussions that will follow thereafter. And I'm confident that the learnings you will gain from this webinar will help you to improve and further refine your approach to stock market investing. I wish you all an insightful and interactive webinar, and I believe that at the end of this event, you will emerge more informed and better equipped as investors. Thank you for listening. Back to you, Ori.
Thank you very much, sir. I do believe that it will truly be an insightful session. So to just get things rolling a little bit, I have a question that I would like to pose to our participants here today. If I can ask Friday to please go ahead and project the question. Thank you very much, Friday. So we're going to have you answer this question in the chat box of the Zoom platform. So it simply says, if you're on a TV game show and you could only choose one of the following, which would it be? Would you take 500K in cash? Would you take a 50% chance of 1 million naira? Would you take a 25% chance of 2 million naira or 5% chance of 5 million naira? So if we can have those answers in the chat box, what would it be? Okay, we have an answer from Ken who says he'll take the 500K. We have, okay, 500K, 500K. Wow, we have a lot of people. Oh, someone actually will take a 5% chance of 5 million. Great, we have 25% of 2 million. But I see most of the answers are still 500,000 in cash. Okay, we have someone who will take a 50% chance of 1 million naira. The 500,000 in cash still has it. Someone says cash is king. We have a few people who will take the 5% chance of 5 million. Wow. Okay, the 5%. So, okay, it looks like we have the cash is king or 5% chance of 5 million. Okay, that's interesting to see. I mean, this speaks to us a bit about, our risk appetite and, what we're more likely to do. Would we rather go with safe investments or are we willing to take some chances? We have quite a number of people taking their chances, 5 million naira. Okay, great. That is great to see. Okay, so while we have those answers coming in, I would also like to indicate that we have a poll. We have a poll that we would like for you all to take today. So I'm just going to go ahead to launch the poll question. So please take your time. You have about 2 minutes to answer the questions in the poll. I'm just going to do that now. So please go ahead, to ask your question, to answer the questions in this poll. You have about 2 minutes to do so. Okay, those poll answers are coming in. Please keep them coming. Okay, I see some people responding to the poll questions within the chat. No, you can actually take the poll directly on the platform. You don't need to answer each question in the chat function. Thank you so much. Okay, we still have about 50 seconds to go on the chat. We still have quite a number of people still responding. Thank you. Ahmed, we note that you've changed your answer to 50% of 2 million. Thank you very much. Okay, we still have a few seconds left on the poll before I take the results. So please, if you haven't responded, please go ahead to do so. We still have a few seconds left. Okay, we still have a few people who haven't responded. So we'll just give you about 15 more seconds to do that, and then I'll go ahead to end the poll and go through the results. Thank you. Okay, so I'm now going to end the poll, and then I'll just give it a moment to launch the results. Okay, so we have 70% of people who received an invite to this event. Thank you very much for honoring that invitation. We're really glad that you're here today. Okay, in terms of attending investment webinars and seminars, we have most people attend these monthly, which is good, which means you're paying attention to your financial decision making, and that's great. For those who it's your first time ever, we hope that this event will make it worth it and will be truly memorable. When would you like to attend another webinar? Okay, we have a lot of people saying next month. We have quite a number of people saying next week as well. At the exchange where we're committed to providing these opportunities for engagement to retail investors. So we will do our best to continue these sorts of engagements and possibly increase the frequency. We have 59% of people who have a stockbroking account, 33% who don't, and 8% who have, but it's inactive. Okay, so we hope that the learnings from today will encourage those who are inactive to get back in the game. For those who don't have, like we indicated earlier, you have an opportunity to learn how you can invest and how you can open a stockbroking account before this webinar ends today. So thank you all for participating in the poll. Okay, so now we're going to go to our first presentation of the day, which is why we're all here. So I'd like to invite Mustafa Alao, Investment Research Analyst at ARM, to take his presentation on value investing. Mr. Mustafa, over to you.
Thank you, Ore. Good morning, everyone. Thank you again for joining, and thank the NSC for this partnership that they have with ARM. So just wait for the slides to show up now. Great. All right. So today we're here to talk about value investing versus growth investing. These are two approaches to investing really, and what we're going to try to do today is bring it home, and make it very relatable so that we can really benefit from this presentation and we can really understand these two approaches to investing. We'll begin with value investing, and that's what I'm going to be speaking about. So value investing, I mean, what is that? What is value investing? I mean, value investing is it's essentially really taking investment decisions in the market based on fundamentals. And that's a key word which we're going to be talking about in this presentation. Making investment decisions based on fundamentals. So say in the stock markets now, you invest in a company based on the company's financials, the business prospects of the company, how strong the management of the company is, the valuation of the company. That's another word we're going to be exploring in this presentation. Another fundamentals. So you look at things that indicates how solid the company is, how good the company is when it comes to its fundamentals. And I talked about looking at the company's financials. One of the things you can use to determine how sound the company is are using ratios. So you can use profitability ratios, to see how profitable a company is. You can check how efficient the company is. You can check how liquid the company is. You can check how solvent the company is. So could you please go to the reverse slide? Yeah, thank you. So these are basically checking the fundamentals of the company, seeing how solid, the company is. And that's a key factor to consider as a value investor. Now, value investing is typically associated with buying stocks that are undervalued. And this is the second point. So there's something called bargain hunting, right? And what it really means is what the term suggests, bargain hunting. It's going for stocks that are, you could say they're on sale. So it's like buying investments that are on sale. They're cheaper than what they should ideally be. So it's looking through the markets and finding stocks which are at prices less than what they ideally should be. Okay. And that's where valuing a company or valuing a stock comes in. So when you value a stock and you see that it's trading at a level less than what it ideally should be, then that's another key factor to consider as a value investor. So from these 2 points, you could say that value investing is about being a bargain hunter on solid fundamental stocks. Now, the rate of growth of a company, yes, it is a consideration when it comes to investing, but value investors don't really look out for that. That's not a main priority for value investors. Okay. Could you go to the next slide, please? It is about these 2 points which I've highlighted. Okay. And I've put it here in bold for you guys to see. So it's about being a bargain hunter on solid fundamental stocks. These are the two key factors. Okay. And like I said, it's not as if growth is not a consideration for value investors, but value investors don't really look for those flashy companies, right, that are breaking records or, promising to change the world, with groundbreaking innovation. Okay. So because of that, you find that value investors, they are more willing to put their money behind companies that you could say, they are a lot more stable in the markets. They might be, you can even term them as they are more boring companies. They'll probably not give you that 25% growth, on an annual basis, but they'll give you probably a 6% growth on an annual basis, 8% annual basis, but they're solid, They're solid. Now, I was talking about looking at a company and valuing it, and being a bargain hunter, right? And if you look at the chart, the illustration that is on the right side of the screen, you see that the company price is on a trend, the fair value is on a trend. The arrow that points to the fair value, okay, the arrow that points to where it's trading at the fair value, that is when you can say that a company is trading at a more ideal price or trading at what they call an intrinsic value. Okay, so if we're going to give an example for it now, say for example, you go to the markets, okay, you go to the markets and then you find you want to get a shoe, and then you find a designer shoe, maybe like a Gucci shoe, for example. Obviously, we know that designer shoes typically are more expensive, in the market than locally handmade shoes, for example. But you find that this Gucci shoe is the same price as every other shoe in the market. Now, hold on a minute. What's going on here? This Gucci shoe should be more expensive, you know. Then you know that this Gucci shoe is undervalued. And that is one of the things that would attract a value investor. Okay. That's one of the things that will attract a value investor because they are bargain hunters. So when they buy that Gucci shoe at that point in time, when the market corrects itself, okay, it's probably because of a temporary headwind, that that Gucci as a company are experiencing, that led to investors to you know to sell off their Gucci stocks, for example, which made the Gucci shoe to go to a low price. But when the market corrects itself, you realize that the price of the Gucci shoe will now go back to a fairer value. Okay, it's go back to a fairer value, and then value investors, which came in at a price which was less than its fair value, they would have accumulated returns by the time the price of the Gucci shoe goes back to a fairer value than it was initially. So bringing it back to the stocks and leaving shoes alone, a value investor will focus more on companies with solid fundamentals, okay, and they are more mature companies typically because they are typically further into their life cycle. But maybe at that point they might be out of favor with the markets due to a temporary headwind, So that's when value investors come in and take advantage of the situation. Next slide, please. Now, to just summarize what we've talked about, it still hinges on these two main points: solid fundamentals and the value, the valuation of the company. Your strategy as a value investor should be, looking at the company, thoroughly researching the company so you can make a good decision, so you can, make a common sense decision, because you don't want to invest in a company that has bad fundamentals, because that would be contradictory to the approach of a value investor. Okay, so thoroughly research the company to make a good decision. Look at the company's financials. Look at how strong the management is. Look at the prospects of the company, and there are ways in which you can do this by even looking at the numbers, and that we'll talk about a bit more in this presentation. So thoroughly researching the company, find the company's fair value, okay? Find the company's fair value. Now, what way can you decide that this company is actually trading at a price that is less than its fair value? This company at this moment, or this stock at this moment, is actually a bargain. I can buy it now, and when the market corrects itself, it should, it should appreciate, and I should be able to make gains from that. How do you value that company? Now, there are a series of ways in which we can do that when it comes to stocks, but one way which is, quite basic and quite straightforward is something called a PE ratio. So PE ratios are good indicators. PE ratios are good indicators for, lower PE ratios are good indicators for a value stock. Can we move to the next slide, please? So let's talk about the PE ratio firstly. So the PE ratio, what it basically does is that it divides the stock price by its earnings per share in order to show the investor how much they are paying per naira of annual profits. So with the PE ratio, investors, they can see which company is the cheapest in their industry. So say company A has a PE ratio of 4 or 4 times, and other companies within the same industry, company A's peers, they have a PE ratio of 10 times. Okay, then the value investor will look into company A to make sure that it has solid fundamentals, because it has identified that company A, it has a lower PE ratio than its peers. So this is a chance for bargain hunting. Okay, and then it takes advantage. So when it looks at the fundamentals, see that the fundamentals are solid, then a value investor sees it as an opportunity to invest. Now, I talked about the value investor, even after seeing that a PE ratio is cheap, should look into the fundamentals. So how do you assess, the fundamentals of a company? How do you see that a company is sound enough? There are many ways you can do that, but these are some ways which are listed here for you to be able to do that, even just by looking at the company's financials. So the things that you should check for the profitability of the company. That's something that, is usually the first thing on the mind of many investors. How profitable is this company? And things you can look at are like the operating profit margin, the net margin. These are ratios, the ROE, the return on equity. These are typical metrics which investors look at when they want to assess how sound the company is, how good the company's fundamentals are. Another thing which investors look at is the efficiency of the company. How efficient is the company? Let's look at the activity of the company. How optimal is this company? And things they look at are things like the inventory turnover. How quickly can a company, turn over their inventory? Look at inventory days. Even look at the assets turnover. Look at payable days. Things like this are to assess the efficiency of the company. Then another thing people look at is the liquidity. Okay, so look at the liquidity of the company. It's really checking how liquid the company is. Things like checking the current ratio of the company. Even a cash conversion cycle. These are ways that people use to assess these different metrics. Also the leverage of the company. Then obviously solvency as well. How well can a company well can a company fulfill its long-term obligations, for example. Looking at the debt ratio, even the debt to equity ratio is even an indicator of how solvent a company is. The financial leverage ratio as well. And also the cash flow. Cash flow of a company. Looking at the cash flow to revenue, cash return on equity, even the debt coverage ratio. So these are things that the value investor looks at. And if they are sound, then you can say that this company has solid fundamentals. Okay, the company has solid fundamentals, because remember, you want to have both of those boxes ticked. If a company looks like it has a low PE ratio and you think, oh, this is a great opportunity for bargain hunting, right? Because maybe it hasn't had favor with investors of recent, and then one just invest in it, right? Without looking at the fundamentals. It's possible that the reason that the company has low PE ratio is because the fundamentals are not good. Something is wrong with the company, on a fundamental level. So a value investor, going back to what we said initially, is looking to make sure that it's good value. That's number one. That's being a bargain hunter, and you are investing in stocks that are solid on a fundamental level. Next slide, please. So on the Nigerian Stock Exchange, there are companies which you can classify as value stocks, which value investors can look at. And another key factor to look at as a value investor is dividends. A company that pays dividend is a company that value investors should look at, because in a situation whereby a value investor does bargain hunting and buys maybe a UBA, for example, and probably it has a low P at that point, probably because of some temporary headwind. In the chance that UBA doesn't appreciate within the time period that an investor might want it to, the investor could still benefit from dividends, and the investor might not lose as much because he bought it at a low price in the first place. So companies like UBA, Dangote Sugar, First Bank, and there are also ETFs on the exchange which contain value stocks. So these are options on the NSE which you can explore as a value investor. Next slide, please. Foreign stocks as well. We have companies like AT&T, JP Morgan, McDonald's, and you realize that these are stocks that, on a fundamental level, they are good. They are in a later stage of their life cycle. They are quite mature. They have strong management. And they are relatively of good value. These are stocks internationally that one can look at if they want to take the approach of value investing. Next slide, please. So let's look at some of the benefits of value investing. I mean, it's lower risk and volatility. If going back to some of the characteristics of value stocks, which I talked about, they might not necessarily be the stocks that will give you 25-30% appreciation, in a year, but they are steady. They're slow and steady. They have lower risk when they fall. It's typically not too bad, for your portfolio, and even when they rise, it's typically not as exponential as growth stocks, which my colleague Oluwaseyi will speak on later. But there are stocks that are really good for investors that are risk averse. They're affordable as well. When you have a stock that has a low P ratio and good fundamentals, and then you invest in as a value investor, it's a good approach if one wants to, one has a budget for investing, one wants to, make sure that they get good value for good value for their money. It's affordable, and we have retail investors here. This is something that we should consider. It's great for compounding. Value investing is an ideal way to take advantage of the power of compounding. When you reinvest the returns and dividend you earn from your value stocks, your profits will grow exponentially over time. So in essence, your earnings will eventually begin to generate earnings on their own. The value stocks typically pay dividends, as I mentioned earlier. Dividends are another factor that value investors look out for. And they're suitable for passive investors. If you want to, if you have maybe a long-term horizon, for example, and you want to invest in, you are not that active as an investor, value stocks are a good option to look at, for you to place your funds in, and they compound and grow over time, typically. Thank you.
Thank you very much, Mustafa. So again, if you have any questions on that presentation, again, please put it in the Q&A box. I see that we have quite a number of questions there already. Those will be addressed as much as possible towards the end of the program. So we're going to move quickly now to the presentation on growth investing from Sheyi Adeosun, Equities Portfolio Manager at ARM. Sheyi, over to you.
All right, thank you very much, Ore, and hello, everybody. I would be speaking about growth investing. And to just dive right quickly into it, what is growth investing? Just like the name implies, it's basically an investment style. So, right, it's a style or an approach to investing where you basically look for companies that are expected to grow. So companies basically that are expected to grow over the short to, the mid to long term, let me just put it that way. Companies that are probably in an industry or in a sector of the economy that is expected to grow. It could be a new company, it could be an already existing company. These are also companies that, of course, you expect them, they have potentials, and maybe as a result of their business model, like I mentioned earlier, the industrial markets they are operating in. Also, it could be as a result of probably the development of a new product or service, right? So basically, the crux of it is you're able to see that, okay, this company has potentials as a result of their environment, either the industry, the sector, their product or service, right? And it would be good to mention as well that for growth style of investing, usually the companies in this space do not pay dividends. And why is that, if you ask me? The reason is because companies that are growing or expected to still grow, they need as much cash as possible that is available to them, right? And so when they declare profits, rather than pay dividends to investors, they rather plow back those profits, the profits into their business for further expansion. And so what's the catch when you adopt the growth style of investing? The catch basically is making your returns from price appreciation. So what does that mean? You want to buy the stock at, for example, 5 naira, and expect that it will, as the company grows, of course, you expect that all things being equal, the share price will equally grow. As the company grows, makes more revenue and profits, you expect that the share price will also grow. And so you want to buy it, for instance, at 5 naira, and then you want to be able to sell it at maybe 20 naira, 25 naira, even 50 naira. So basically, you make your money as an investor when you adopt the growth style of investing from price appreciation of the stock rather than dividends. Because again, like I mentioned, just to reiterate, most of the companies in this bucket usually need as much cash or funding as possible to continually grow their business. Next slide, please. Okay, so to just give a couple of indicators that could guide you in identifying a growth company when you want to adopt this style of investment. One is attractive ROEs. What do I mean by ROEs? Return on equity. Basically, what return on equity says is it basically tells you how the company is able to use shareholders' funds to make money. Basically, that's what it tells you. So it signals to you how efficient or how effectively the company is able to turn over shareholders' funds in making money. And how is this calculated? You basically divide the company's profit by the average shareholders' funds. Basically, that's how it's calculated. And of course, the higher the ROE of the company, the more attractive it should be. And it's a major indicator for you when you're adopting this style of investment. Another thing to consider is price to earnings ratio. My colleague Mustafa spoke about this also. Price to earnings ratio basically tells you how expensive a stock is. Now, I should mention that growth stocks are usually expensive. And the reason is because, if you look at, if you recall your normal demand and supply mechanism, where the higher the demand, the higher the price. Now, a lot of people like to buy growth stocks because they give you significant returns, right? And so because there's always a lot of demand for growth stocks, usually growth stocks are always expensive. So it's something to also note. Another indicator or thing to note here when adopting this style is profit margins. What do I mean by profit margins? First off, you know that the fact that a company is growing revenue doesn't exactly mean that it's profitable. So for instance, if a company is growing its revenue and its cost is actually growing faster than it's growing its revenue, then the company might not be profitable at the end of the day. It might even be making a loss, despite the fact that it's growing revenue. So what profit margins tell you is basically how profitable the company is. I mean, to put it in plain terms, it's your net profit or net income divided by revenue of the company. So basically, it wants to see of the total revenue of the company, or as the company's revenue is growing, what portion of this do you get translates into profit? Basically, it also gives you a bit of sense as to the company's efficiency. Another thing you want to be able to identify as a major indicator is the historical and forecasted earnings growth. So you want to be sure that the company will be able to grow its earnings. That's very, very key. I mean, that's one of the major criteria for a growth stock or a growth company. Be sure that, for a company that has existed, you want to look at the track record of the company over the years and say, okay, how well has it been able to grow its earnings, and how well is it going to be able to continue to grow its earnings, at least into the, foreseeable future. That's also very important. Next slide, please. Okay, so I'll just quickly highlight some strategies that you could adopt, just more or less expanding on the indicators I had mentioned earlier when you're adopting this style of investment. And one is you look for high rising industries. I mean, the good thing about this style of investment is usually the things that are easily relatable, things that happen in our immediate environment, things that, that you and I can see. And so a good example when you're trying to sort of identify high rising industries is, for instance, the advent of COVID has sort of put the spotlight on the healthcare sector. So that, of course, there's a bit of potential. Just to give a bit of example, another one is technology, right? That technology is rapidly growing, keeps growing every time. It's taking over several sectors of the economy. And world over, technology keeps growing rapidly. So, of course, these are a couple of industries that, things that you should basically just look at what is in vogue, look at current trend. If I'm to speak to technology again, you know that some years down the line, for instance, in Nigeria, we used to have something called cyber cafes, right, where everybody used to go to browse. But today, thanks to technology, everyone can access the internet. You can speak to someone anywhere in the world, from the comfort of your living room. In fact, I don't think cyber cafes still exist anymore. But basically what I'm trying to say is technology has grown rapidly. So basically there are pointers around us, things that are in vogue, things that are trending that sort of, could easily give a sense as to identifying what is or put high rising industries basically, and being able to know things that would grow again, going forward into the future as well. Another thing to look at is evaluating future earnings power. And I spoke about this when I was talking about the ability of the company to grow its earnings. So you want to be sure that the company is within a space or it has a product that can grow. A good example is manufacturers of electric vehicles. That the world is sort of taking a slight shift from the regular conventional vehicles that we all know to electric vehicles. So that's a new product, for instance, that that, okay, maybe some 20, 30 years down the line, we're going to have more electric vehicles than we currently do have right now, okay? So, you want to be sure that, okay, this company's product would continue to remain relevant, or this country is in an industry that will remain relevant. And so, the company would continue to grow over the foreseeable future. So ability to evaluate the future earnings power of the company is also very key. Another thing is assessing the quality of senior management. And what do I mean? You have to be sure. For instance, I think in law, it said that a company is a separate legal entity, right? But again, we all still say that a company is made of its people. So basically, even if in the eye of the law, it's a separate legal entity, it's still made up of its people to a large extent. So you want to be sure that the management of the company has the requisite experience, and they can help the company achieve that growth that is expected of the company. And how do you do this? You look at the profile of the senior management or key management staff of the company. If it's a new company, another thing you could do is most times, the management will have worked elsewhere before coming to start the new company. So you want to look at their track record. What's their experience like? Is it relevant to what they are now doing in the company? Do they have the skills? Do they have the competence, basically, to be able to grow, the company as expected? And then the final thing I'll speak about is diversification. How do I explain diversification? It's very simple. Something you and I probably say every day. When you say, do not put all your eggs in one basket, that's basically what you mean by diversification, not putting your eggs in one basket. So as you either start to invest, or if you're a current investor, you always want to have elements of growth stocks in your portfolio. Growth stocks are very important in your portfolio. And the reason is because growth stocks always give you that significant return. They usually grow significantly over time. So, I mean, you expect that, and that at the end of the day, when you have that mix in your portfolio, it helps you sort of boost your portfolio return and help you, make more money over time. Next slide, please. Okay, so to just sort of bring it home and help us relate more with growth stocks, I'll use these companies to sort of expand further on the explanation of growth stock. So I have here Presco PLC. Presco operates in the agro-allied industry, and it's one of the leading players in that space. Now, what is the growth potential of the agro-allied industry, if you ask me? I'll tell you that, first off, for that industry, there's significant demand for crude palm oil, because that's at the end of the day, the sort of the product that comes out that industry is known for, crude palm oil. And crude palm oil is known for a lot of things. I mean, it's used by industries and companies for producing soap and other products. It's used by consumers as what we know as palm oil that we used to cook. And so there's significant demand in that space. Now, the good news, I should say, is that the supply is very limited. And so there are just very few players in that space. And because the supply is very limited, it means that the total output of that industry right now is not even sufficient to meet the demand. And so that shows you that there are potentials there. And why is this so? Because there's what I would call high barrier to entry. And then what do I mean by that? There's usually a 3 to 4 year period for you to plant. Okay, so how it works is you need to plant palm trees, right? It's when you plant the palm trees, and at the point of harvesting, you harvest what you call the fresh fruit bunches, and that's what is now produced and processed into crude palm oil. Now, it takes about 3 to 4 years for you to plant and have, from planting stage up until the stage of harvesting. And so, I mean, that takes a while. So it means that if you enter the industry today, you cannot do anything until after 3 or 4 years when you started harvesting, right? And so because of that, I mean, a lot of people would not want to go into it, because first off, you invest a lot in getting land. You need a large expanse of land. So you invest a lot. You're basically tying up capital for like 3 or 4 years before you then start to harvest. And then you then start to have, you can then start producing before you start selling. So basically, that basically speaks to the potential in that space. Another one I would speak to is Seplat, who operates in the oil and gas space. It's one of the few indigenous companies we have, particularly in the upstream sector of the oil and gas industry. And what's the potential in the oil and gas industry, if you ask me? According to data from OPEC, which is the Organization of Petroleum Exporting Countries, Nigeria's proven crude oil reserves is about 37 billion barrels of oil. And of course, we all know that oil today is the major driver of Nigeria's economy. That's on one hand. On the other hand, which is the gas side, according to OPEC as well, Nigeria's proven natural gas reserve stands at about 6 trillion cubic feet. And so that goes to tell you that in terms of the resources, Nigeria is blessed significantly with these resources. So of course, that gives a potential for growth in that space. Also, I mean, there's a lot of demand from industries for gas. Industries now use gas, sort of convert gas to electricity, use gas for powering machines and different things. Also, recently, the president had also approved for, I think, the NNPC or so to sort of start looking at possibility of using gas to power vehicles. So basically, just to also, give a bit of context as to the growth potentials in the oil and gas space. Another one I'll speak about is MTN. I'm sure we all know the telecoms company. MTN, of course, is a telecoms company, and telecoms companies have grown significantly. I mean, I remember in the early 2000s when mobile phone just came into Nigeria, and now, of course, mobile penetration has grown over the time. And then I'll say another thing that has helped the telecom space is, again, technology, data. COVID has sort of been a blessing to this sector, to the telecom space. Why? Because, last year we're on lockdown at some point, and everybody still needed to work, staff of organizations still needed to work, and everybody were using data. So of course, data has grown, at least even if you look at it between March last year, thereabout, and now, data usage has grown significantly. And there's still more opportunity, right, for data usage to still grow. And so that's a very good opportunity or a potential, so to speak, from the growth side now for that space. Another growth factor, I should say, in the telecom space is when you look at what the new payment service banking model that the CBN is adopting. The edge the telecoms companies have over the banks is the fact that they've been able to penetrate more people than the banks have been able to reach. And so if you look at the hinterlands, you have places where you do not have banks, right? But you still have at least 1 or 2% in those areas that have mobile phones, right? So what the payment service banking model would the advantage to the telecoms company is if granted the approval by the CBN, they'll be able to use that to scale and even improve their revenue, by operating that payment service banking, model. So, I mean, this just goes ahead to speak to the growth potentials in that space. We also have exchange traded funds on the Nigerian Stock Exchange that have growth stocks, right, as their underlying securities that, could also help. I mean, basically exchange traded funds that are tracking growth stocks, basically as they have those growth stocks at their underlying securities. And that's also, to speak to, the importance of, or the opportunity, so to speak, for growth investing in the Nigerian capital market. Next slide, please. Okay, so let's look at the global scene now. I mean, Microsoft is one company that is probably a household name that everybody knows. I mean, there's hardly any organization that doesn't use a Microsoft application or software or product, right? And of course, Microsoft itself has grown. Again, COVID has been a blessing to the technology sector. I mean, for instance, we're having this webinar now via a technology platform, right? And I mean, probably a year ago or 2 years ago, we probably have had this, probably wouldn't have had this virtually. But today, everybody has embraced technology. And of course, Microsoft has grown as well, and is still growing. I mean, as technology begins to sort of, inch up into or sort of affect other sectors, that other sectors are basically beginning to use technology. And Microsoft, again, is a name in that technology space that has grown and has potentials. Of course, there are other names. I mean, it's just by way of an example. We have Amazon as well. Amazon is an e-commerce company, right? And e-commerce has grown and is still growing. I mean, COVID again has made e-commerce to be more prominent because, I mean, prior to now, a lot of people still used to go to markets and all of that to buy stuff. But today, I mean, or since COVID, that has increased. The use of e-commerce for shopping has increased significantly. And the beauty of it, again, is riding on technology is the fact that with Amazon, you can shop from the comfort of your home from anywhere in the world. So you don't even have to get a visa, buy a plane ticket to travel and buy products from the comfort of your home, right? You can shop and you get your items delivered to you. And so again, that's just to speak to, the potentials there, and it still has that potential to grow. In fact, I think they've also started a payment service thereabout, if I'm correct now, so basically just telling you that there are a lot of opportunities, when you look at growth companies, being able to identify their growth potentials is very essential. Tesla is a company that probably was not known some 10 years ago. Today, at some point, the owner of Tesla was named the richest man in the world because of how much the company had grown, right? And what does Tesla do? Tesla is one of the manufacturers or is a manufacturer of electric vehicles. Now, I mean, some 10 years ago, probably never believed that vehicles will be able to run on batteries but today we're beginning to see it grow, and it still has a lot of potentials to grow. Why? Because, I mean, in Nigeria, for instance, or even in Africa, we do not have a lot of electric vehicles. We have just very few, you probably can count. Even in the developed world, where or in developed economies where electric vehicle is growing rapidly as well, you still have a lot of people that do not use it. So that's to let you know that, there are a lot of potentials. And the reason why this would also grow is because, there's a lot of clamor these days for climate control, climate change, and all those things. And this sort of promotes green energy because, it reduces combustion and all those things because of the way it's powered, So just to give a bit of example and context, and to just wrap up my presentation, next slide, I'll just speak to the benefits of adopting a growth investing style or investing in growth stocks. So like I'd mentioned in the course of my presentation, one is attractive returns through stock appreciation. I mean, growth stocks, if you're someone who likes dividends, then growth stock or growth style of investing is not for you. But growth stocks will always give you price appreciation. So, I mean, you buy a stock at a price, and in like 5 years, 10 years, it grows significantly, right? And gives you that return that you want. Diversification, I've mentioned it, because of the growth potentials or the significant or attractive returns that growth stocks could give you. It's always good to have them in your portfolio because, I mean, they help you to boost your portfolio returns. Also, it helps you to be associated with successful companies because as an equity investor, you're sort of a part owner of the company. When you own a share of the company, you're a part owner of the company. And so any company is expected to grow, is expected to be successful. So it gives you that sense of, being associated to highly successful companies. So imagine, you own a growth stock today in your portfolio, you're happy. When you see it growing, you're like, yeah, I'm a shareholder in that company, right? Also is potentials to outperform the market. When I started my presentation, I'd said stocks are expected to grow faster than the market, grow faster than the economy. So of course, they have that potential to, outperform. And lastly is, if you use the indicators I had mentioned, besides, other fundamental factors that you need to do as an equity investor, it's sort of easy to identify companies. And again, like I said, the factors to identify growth industries or growth companies are easily relatable. They are trends, things that are in vogue, right? So it makes it easy to, sort of identify growth stocks. That brings my presentation to an end. Thank you very much.
Thank you very much, Shay. That was indeed an insightful and enlightening one. So now we're going to go straight into the engagement session for today. I would like to introduce the head of the X Academy, Ugochi Obi, to take us into the versus session for today. Ugochi, over to you.
Thank you, Ore. Oh my goodness, we have loads of questions. So we're going to try and squeeze them within the little minutes we have. Mustafa and Shay, I hope you are ready to roll. So I'm going to start with a question, which is more like a scenario, and it's directed at you, Shay. It's saying that a young man who recently graduated from the university is looking to raise money to buy a car in the next 2 years. Should he be looking to use a growth strategy or a value strategy? Yeah,
all right.
Shane,
okay. So I would say, of course, someone who's looking to buy a car in 2 years obviously needs his funds to grow. So certainly I'll be saying a growth strategy is what you should look at. But I would like to sort of state a caveat. And caveat is the fact that, and if maybe I didn't mention it in the course of my presentation, I should mention that growth stocks or growth in style of investing is also is risky. It has its risk, right? So you need to be mindful of that. You need to be mindful of the risk. But of course, the growth style is what will give you that sort of appreciation or return that will help you meet that objective.
Thank you, Shay. Now your caveat has got us thinking. Mustafa, what do you have to say to that? Should it go growth or should it be value?
Well, this young man looking at 2 years to buy a car, that's 24 months. And, and you are somewhat of a short-term investor. I'll pin short-term investing to 18 months or less. And short-term value investing is a bit of an oxymoron, really, because I was to say value investing now, and you're looking at that time, that horizon. So even if you use the PE ratio, which we spoke about, to find companies that have value, but you can't know when the market will realize said value, and the market timing is needed to fit to your short-term window. True value investing is about a more long-term strategy. But what I would say is you should pick a good mix, right? You should pick a good mix, and that would be, I believe that would be appropriate for you, and also take into account your risk appetites. As Sheyi rightfully said, growth investing comes with a significant amount of risk. So if you're prioritizing that growth, and you also want some form of stability, a good mix of both of them will be good for you.
That's comforting to hear. Mustafa, while you're on it, considering the current economic headwinds, okay, some will say there is a market downturn now. So convince a young investor on whether he should take a growth or a value strategy.
Well, the current economic headwinds in Nigeria are, peculiar on many layers. And, when there is uncertainty, that exacerbates the level of risk. And we just talked about how, there's risk involved with growth. There is risk involved with value, but when we're talking about volatility now, it's more with growth. And looking at an environment, an atmosphere with, high levels of uncertainties, there are different policies coming. Nigeria is very hinged to the oil market. You know how the global oil market is, very susceptible to, different things. Just one attack can send oil prices flying, and just an argument between OPEC members can send oil prices tanking. So, in an area, in an atmosphere like Nigeria, whereby there's uncertainty, and especially considering our current economic headwinds, I would say, you want to try and maximize stability as much as possible in your portfolio. So from that angle, I would say, value investing, should be where you should take. Another factor to consider is that, at the moment, many might, argue that, some tickers on the Nigerian stock exchange, because if you look at last year, the Nigerian stock exchange was one of the best performing markets, equity markets globally. So in light of that, you might want to be careful and make sure you don't invest in stocks that are probably, above their intrinsic value, above their fair values, and also target dividend paying stocks. So in light of that, I would say a value strategy should be what you should consider.
Thank you, Mustafa. Sheyi, Mustafa has a point on the dividend aspect. What do you have to say to that question?
Okay, what I would say would be, first, you need to be mindful of what position or where the economy is in its economic life cycle, right? And then if you look, the latest GDP numbers for Q4 2020 sort of show that Nigeria exited a recession, having recorded 2 consecutive declines. And so basically, 2021 for Nigeria is an economic recovery story, right? And at the point of economic recovery, what is always good to adopt the growth style or to invest in growth stocks, because they're expected to grow faster. They would even grow faster than the economy, expected, right? So given this current stage of our life cycle of the economic life cycle for Nigeria, growth stock would be what I would recommend at this time.
Okay, thank you, Sheyi. Thank you for and Mustafa for giving an answer to that. That again is quite comforting. So, Mustafa, I have a more elaborate question directed at you from Mary. It's quite long, so I'm going to read it carefully. She's saying that a company recently ran into trouble, and the price of its stock starts to decline. Given the belief that value stocks are inexpensive, she's asking, can I buy that company's stock as a value stock, which I can add to my portfolio? Can I expect to receive the fundamental returns I would normally expect from a value stock? Did you get that?
Yes, I did.
Fantastic.
Well, Mary, if you know, in our presentation, we talked about two, key factors that generally, as an investor who is taking the value approach, as a value investor, should look at. One of it you've identified, which is great, a stock that is, of value, something that, is probably at a lower PE ratio than its peers, it's inexpensive now, the price has declined. That's one. But the second thing, is it, have you fulfilled that? If you look at the company and you see that the fundamentals of the company, the profitability, the efficiency, the liquidity, the solvency, if you look at how solid the company is, if that box is ticked as well, then I would say great. That's, you should go for that. That's value investing, that's a value stock, because you want to be careful, because the price of a stock is declining does not just automatically mean that, oh, low price is great, let me invest, my go up. What if the reason that the price of the stock is declining is because maybe that company, is entering bankruptcy, or that company, is the outlook for the company is basically, completely bad. There's, very little hope for that company. So you want to be careful. So you want to check those two things. The first one is you've identified, great, it's, good value. Secondly, the fundamentals, look at the, how solid the company is. If it's solid enough, then great. That's when you should add it to your portfolio.
Okay, great. Thank you, Mustafa. Mary, I hope your question has been answered. Shay, don't go off. You've got one directed at you. You have convinced Joseph, and he's saying that he is a growth inclined investor, but he's asking that does the fact that a company does not pay dividend necessarily signify that it's a growth stock?
Okay, I would say it's a means to an end, but it's not an end in itself. So what do I mean? Of course, like I mentioned during my presentation, most growth companies do not pay dividend, right? So, but the fact that it doesn't pay dividend, that's not the only thing to consider. There are other factors to consider, right? So like I mentioned, you still have to look at, the quality of its management. You need to look at the profit margins. You need to look at the ROEs. You need to look at, historical and forecasted earnings growth. You need to look at the industry in which it operates. You need to look at its business model, and also consider other fundamental factors, to invest in. So it's a part, but it's not all by itself. I mean, the fact that it's not paying dividend doesn't just make it a great stock. I mean, there are other things to consider as well. I hope that answers that question.
I hope so. I'm sure it does. That Joseph is convinced now. So again, I see varied questions, and I can see that people are quite convinced. So they're asking, or there's a question here that says, what can a value investor or growth investor look forward to in the year 2021 with the whole outlook that has been given? What can a value investor or growth investor look forward to in the year 2021? What are the areas to watch? Shay, let me ask you to take that first.
Okay, thank you, Gochi. So, I mean, like I said, first off is, I mean, if you use a top-down approach, right? So you first want to look at the economy, and then you then drill down. First off, like I mentioned when I was answering the other question, that currently, I mean, this is a recovery story for Nigeria, given the recession we are plunged into as a result of COVID and its effects. And so, right now, what you expect, given that we expect, of course, we started a recovery, so I'm on an economic recovery path. What growth stocks will do for you in this instance is to give you that much expected return over the long term. I should also state that, usually when you're doing equity investments, you look at the long term, not the short term, right? So you expect to, take advantage of growth stocks to give you the much expected, or the attractive returns that you need as an investor. So that's basically what I'll say. Another thing to just add to it is, timing is also key when you're doing investment. You need to, so as much as you have identified a stock as being a growth stock and it's good and all of that, you need to also know the timing. The right timing is what makes you a very good investor, right? So, and you know how there's a popular lingua in the market that says you buy low, you sell high, right? So you want to be able to buy a stock at the time where the price is low, and of recent we've seen some declines in stock prices right now in the market, so you could also use this as an opportunity, to enter into or to take your positions. But timing is very key, so you need to be mindful of that as well. Thank you.
Thank you, Shay. Right timing. Mustafa, what do you want to add to that question in terms of what to look forward to in the year 2021?
Yes, I mean, Shay hit the nail on the head. So, in 2021, we just recently came out of, a recession technically, and I think a lot of it depends on, on the individual. But what I would say about both approaches to investing is to make sure that the fundamentals are in place. And I know that I might be making a case for growth investing now, but if you're looking at a company like Seplat, right, which Oluwaseyi had identified as a growth stock, you see that last year the oil market was traded at oil prices traded at a yellow of $19.33. They took a significant hit, but their cash balances, for example, was quite solid, So looking into 2021, oil prices at the moment, it touched $70 per barrel over the weekend. Things are looking up for oil prices. So what we expect is that would, trickle into a company like Seplat and other upstream players as well. So I think looking at those fundamentals, right, whether you're going for value or growth, those are what, one should take into account. Yes, value might not give you, like the exponential growth in terms of annual returns like value might give you, but what I think you should look out for this year, amidst this recovery, amidst the uncertainty, is just companies that have, as much stability as possible overall.
Okay, thank you, Mustafa and Shay. Please, participants, send in your questions through the Q&A. Please keep sending them in. We'll be able to read them through the Q&A. So, Mustafa, if I'll ask again, and I have this question, okay, and it's saying, please tell me, growth or value in one sentence, which one is the best? I think this person just wants to be convinced. Just tell me, growth or value, which one is best? So, Mustafa, I'm going to ask you, growth or value, which is best?
Well, unfortunately, I'm not going to be able to give you a direct answer like, oh, this is best. That is not as good. But what I would say is that, a lot of it is, is subjective. It depends on what you want. It depends on your horizon. There's something called an IPS. It's an investment policy statement, which you fill with your portfolio manager, and on it, they ask for your horizon. They ask for your risk appetite. So it really depends on you. If you are, there are retail investors here, so I would imagine that, we're on the younger side here. This is the time to, you want to take risk. You want to take more risk as opposed to probably people close to retirement or in retirement. So in light of that, I would say that, growth investing, and I'm making a case for Oluwaseyi here again, but growth investing is something that you might want to consider. But if you're someone that's, a bit more risk averse, wants good amount of stability, you want compounding over a long term, then value investing is what you should go for. So sorry again that I didn't give a direct answer like this is best, this is not as good.
Well, let me ask Shay, since you've not given me that answer I want. Shay, this is to you. Growth or value, which is best?
Okay, thank you. really, I don't think I would say anything different, so much different from what my colleague Mustafa had said. But what I would say is really these things depend on individuals. I mean, we all have different preferences as individuals. And so, I mean, there's some people that when you lock in money, you want to, what's the word? You at least you need some returns, right? You need at least within a year, you want to start seeing some of inflow from the money you've invested. And so obviously that speaks to the fact that you probably are a dividend seeking investor. And of course you should then, consider the value. But on the growth side, like I said, most times you don't get dividends, right? And so it's more of price appreciation. What I would say is also to help give it a bit of context is if you're a young person, you probably want to look at growth if you do not mind not getting dividends. So, I mean, because you have a lot of time off your hands, you can lock in funds, I mean, for the next 3, 4, 5 years or longer. You could want to consider the growth style, but really it depends at the end of the day to individuals and your preferences. Thank you.
Okay, thank you very much, Shay. Oh my goodness, I'm just being told that I don't have any more time, but there is this interesting question, and I will please like to be given 2 more minutes. Shay and Mustafa, I'm going to direct this question to you. Remember, we don't have time, but it's quite interesting, and it is from Temito, where she's asking if she can't seem to decide which strategy to follow, which also led us to that question. But she's torn between the 2 strategies. Can you tell her how she can blend the 2 strategies or build a combined portfolio for both strategies? I found that question interesting. Did you get it? Let me start with you, Mustafa. Did you get the question?
Yeah, so how she can blend both approaches, right?
Mm-hmm.
Firstly is, it's good to blend both of them, and what you can do is explore ETFs, so exchange traded funds. You can invest both in, the value and the growth. And again, this is, I'm repeating this because this is actually important. It depends on, it's subjective. It depends on your risk appetite. People might have probably 70% growth, 30% value. People might have 30% value, 70% growth. It depends on what what you want, what your risk appetites are. What I would say you should do is that you should, revise what we spoke about, when it comes to the characteristics of a growth investor and a value investor. Identify the kind of person you are based on those and invest accordingly.
Thank you, Mustafa. Shay, what do you say?
Okay, to just add to what Mustafa said, I would say that at least having listened to both of us, I'm sure to a large extent, everyone can sort of pick where they fit into, right? And that would that would sort of give a guide. And so in terms of blending it, it would always still, your individual preference in terms of either growth or value will still be what will be, more prominent at the end of the day. So, I mean, like Mustafa said, whilst blending it, of course, it's always good to, blend it and have a diversified portfolio, like I spoke about. Do not put all your eggs in one basket, right? But your individual preference. So, for instance, if you like dividends, right, or you're dividend seeking, it means that you probably have more value than growth. But it will be good to have growth. But of course, you have more value than growth. And then if you like growth, you're young, you have a lot of time, and all of that. Of course, you have more growth than value. So at the end of the day, it still boils down to what I said last time, your individual preference.
Thank you, Shay and Mustafa. And for the participants, please, send me your questions as we continue. Unfortunately, we're out of time, but we will answer your questions and send them back to you. And then at the end of the session, you'll see our contact details. So with that said, it's back to you, all right? Thank you.
Thank you very much, Ugochi. Thank you, Mustafa. Thank you, Sheyi. The questions, like you said, are pouring in. So like Ugochi said, please keep them coming. We'll do our best to answer all your questions and send them back to you. And our contact details will be shared at the end of this webinar. So now I'm just going to go very quickly to go to our second poll of today. So I'm just going to launch the poll now. We're going to have just about 2 minutes because, you know, we're a little behind time. So I'm going to launch the poll now, and you're going to have 2 minutes to answer the questions. So just give me a moment, okay? Okay, the poll is now live, so please go ahead to answer the questions. You have about 2 minutes to do that, and then we'll move on to the presentation from Mr. Mababiola. Thank you. Okay, the responses have started coming in. Thank you. And yes, for those who are requesting for the presentation, we will get back to you on that after the webinar. But you will always be able to go through the learnings from today on our YouTube channel. I'll just post the link for that in the chat box so that you can always go through the event again from our YouTube channel. Okay, we're over a minute now on the poll. Please keep those responses coming. I see a lot of engagement in the chat box as well. So there are learnings there as well. So if you do have some time, you could also go through that. Thank you. Well, coming up on 2 minutes now. We have just a few seconds to go, and I'll go through the results of the poll. Okay, so we've hit the 2-minute mark. I'm going to close the poll now and share the results. Okay, so thank you very much for filling this. So the major aim of investing in the capital market, most people are after consistent growth. Okay, we have with a few people for capital preservation, others for quick profit, and the smallest number for liquidity. Do you think the capital market is good enough to grow wealth? Awesome. We have 81% of people who say yes. We do definitely agree with you on that. We have which investment strategy do you prefer? Wow, we are evenly matched on that. So Sheyi and Mustafa, I'm not sure if you need to do more work in pushing your arguments, but we're evenly matched on value and growth investing. And for those who are undecided, we hope that as you interact more with the market and as you learn more from these sessions, you'll be able to make that decision based on your investment objectives, your risk appetite, and all of that. So do you know what it takes to invest in the capital market? Yes, very well. 47% say just a little. Okay, so we'll have a session from Mr. Magwabiola to address how you can invest in the capital market shortly. When would you like to attend another webinar? Next month, next week. We are definitely committed at the exchange to having these engagement sessions for the benefit of the entire capital market and our investors. So without further ado, I would like to invite Mr. Benga, my apologies, Mr. Benga Magwabiola, the Managing Director, ARM Securities Limited, for his presentation. Thank you.
Good afternoon. It's my pleasure to be here. Good afternoon, everybody. I hope that these sessions have been insightful. I can see many of the comments, and I think clearly this was a fruitful session. So how do you invest? That's a very good question. After listening to all the argument, both sides of the argument, I think the simple answer, thanks to technology these days, is that technology has made it easy for you to open investment accounts, trading investment accounts, and literally anybody can whip up their smart devices or their PCs and select a broker of their choice, and then just initiate an account setup and begin to trade. As simple as that sounds, that's the reality, and we have technology to thank for that. But how do you really go about investing profitably? I think that's another way to spin it. And just to lend my voice to that, I would say that the first thing you need to do, as a new investor or an existing investor, is and you want to make going forward profitable investment decisions, is to select a stockbroker. You need to select a reputable stockbroker, and a stockbroker will do two things for you. A stockbroker will help you to refine your investment strategy, just like we've talked about. The panelists talked about growth versus value investing. These are strategies that have been proven over time to be very rewarding for investors. Talking to a stockbroker will help you to refine those strategies to be able to suit your peculiar investment goals. So there are other strategies as well, and approaches to investing that a seasoned and experienced professional will help you to get. You can be active, you can be passive, and look at ETFs. You can have a short to medium term approach to the market. You can have a long term view of the market. Those are the things that a stockbroker will help you to assess. So, early on, when you do select a suitable and a qualified stockbroker, the very fundamental thing that will, that relationship will do for you is to define your risk appetite. And, very quickly, risk appetite, I think some of the panelists already mentioned about, young investors and their appetite for risk to be able to take on, large amounts of risk. So typically for younger investors, and I know that there are a lot of young investors in this webinar, your allocation to equities is ideally supposed to be higher up around the 70% range. Because of that time frame that you have to actually invest over a long period of time, to take on risk and ride ups and downs of the market, and also take advantage of potentially rewarding positions in the market. As you grow older, though, you need to scale down on that risk appetite because of your need for more steady income. So your allocation to equities will tend to fall lower, so around 30 and down to 10% as you advance. I think the rule of thumb here is, as we all might have heard before, the higher the risk, the higher the return. And I think I noted a poll earlier on about what you might do, whether you take 500,000 naira cash or you take 5% or 5 million. I think that particular poll was very instructive. That poll, if it was taken any other time, will probably reveal the same thing. Fewer people are ready to take risk, and that's why it's that proposition. It's high risk that poses high potential reward. So the other thing that a stockbroker will do for you is to facilitate your trading account. So your stockbroker will help you to open an account, and just like I mentioned before, this is made easy, a lot easier now these days with the advent of technology and online trading platforms. When you choose ARM Securities, like ARM Securities will give you access to very easy channels in opening trading accounts. And by simply just downloading the mobile app, as you'll see on your screen, on the Play Store or on the iOS, you can get access to the market, real-time trading, real-time prices, real-time price movement. And I think that puts the power in your hands as an investor to be able to see the market, see the movement, and take opportunities as they present in the market. So ARM is able to give you this opportunity and these portable channels for you to access the market. You can also open an account and trade on our web portal, www.armstocktrade.com, and you have easy access and similar access to market insight. Additionally, what you can get from our portals and our online channels are our research. Somebody mentioned in the chat about how they might be able to access research. Our research, very well-researched stock selection is available on those channels. So you can have access to our research and recommendations, that will help you to make great decisions for profitable investment. So that said, and not to take too much of our time, investing is a journey. Whichever strategy you settle for, with good advice, always with good advice from seasoned professionals. Investing itself and investment strategies are, a lifelong endeavor, and ARM Securities is happy to, work with you along that journey. And we'll welcome you at any point in time. Feel free to contact us at any time, and we'll help you in your journey for investing. Thank you very much.
Thank you very much, sir. Thank you, Mr. Magabiola. Okay, and then to bring us to the end of this event, we have Chidima Chukwueke Okolo, the head retail investor coverage at the NSE. Chidima, please go ahead.
Good afternoon, everyone. It's indeed an honor to deliver the vote of thanks to close out this stimulating and interactive webinar. It has been truly tremendous. At the Nigerian Stock Exchange, we recognize that it's important that investors receive adequate knowledge of how stock market works and how to take advantage of the opportunities it presents. And I believe we have achieved this today. Let me express our deepest appreciation to all the speakers who have shared their knowledge and experience with us on this webinar. Your contributions were truly insightful and will inspire further discourse and engagement. I'm proud to say that this webinar has been an outstanding one, both in participation and in the quality of conversations we have had. An event of this nature is only made possible through the contribution and commitments of the esteemed participants, organizers, and speakers. I would therefore like to commend the role played by ARM Securities and thank my colleagues in the Retail Investor Coverage Department for putting this event together, Ugo Chiobi for our participation, and our IT and corporate communication teams on both sides. More importantly, perhaps greater gratitude goes to the audience who have joined us across our various online platforms. We appreciate your time and we do not take this for granted. Again, for all the questions we're unable to answer for want of time, we will shortly respond via email. If you have any further questions, please go to our website where you will find our contact details and many more relevant information. Then we'll get back to you shortly. I thank you for listening and please continue to stay safe and in good health. Thank you.
Thank you very much, Chidima. Again, thank you to all our participants for joining us today. We hope that this has truly been an enlightening session. We will continue to be in touch and we ask that you also continue to reach out to us whenever you need to. Thank you all, and this webinar has now come to an end.